Why do two people buy the same Bitcoin at nearly the same price in the same market and walk away with completely different outcomes? One builds confidence, stays patient, and grows wealth over time. The other panics, second-guesses every move, sells at the worst moment, and walks away convinced Bitcoin is a scam. Same asset, same market, the same information is available to both, yet one person gets richer while the other gets emotionally destroyed. That difference is not just about money. It is not just about timing. It is not just about information. It is not about luck, and it is definitely not just about intelligence. The hidden force behind almost every Bitcoin success story and almost every Bitcoin disaster is entirely psychological. And once you understand that, you will never look at investing in Bitcoin or other cryptocurrencies the same way again. Because in the Bitcoin market, for example, people are not only reacting to price, they are reacting to fear, greed, stress, ego, regret, and the constant pressure of uncertainty. Most people think Bitcoin is a technology story. A few others think it's a macroeconomic story. But the real story, the one that determines who wins and who loses, is a story about the human mind. It's about fear, greed, patience, and the ancient wiring inside all of us that was designed for survival on the savannah, not for navigating a volatile digital asset market. And here's the uncomfortable truth. That wiring works against you almost every single time the market moves dramatically in either direction. So today we're going to go deep, not into charts, not into technical analysis, not into price predictions, because nobody can tell you where Bitcoin is going next week or next year, and anyone who claims otherwise is selling you something. What we're going to explore is the internal landscape of the investor, the behavioral patterns, the cognitive traps, the emotional cycles that separate the people who build real wealth from the people who constantly feel like they're just a step behind. Let's start with the most powerful force in the cryptocurrency market: fear. Not fear in the abstract, real, visceral, stomach-dropping fear that arrives the moment you watch an asset you own lose 30, 40, 50% of its value in a matter of weeks. This is where most investors' stories end, not because the asset is worthless, but because the pain of watching those numbers fall becomes psychologically unbearable. The brain doesn't experience financial loss as an abstract concept. It experiences it the same way it would experience a physical threat. Cortisol spikes, rational thinking narrows, the instinct to escape becomes overwhelming. This is what behavioral finance researchers call loss aversion, and it's one of the most well-documented phenomena in all of human psychology. Studies have repeatedly shown that the emotional pain of losing money is roughly twice as powerful as the pleasure of gaining the same amount. Think about what that means in practice. If Bitcoin rises 20%, you feel good. If it falls by 20%, you feel devastated, even if you're in exactly the same position you were in before the rise. That asymmetry drives millions of investors out of the market at exactly the wrong moments. Here's where it gets even more interesting. Loss aversion doesn't act alone. It teams up with another psychological force called herd mentality, and together they create something that functions almost like a collective hallucination in financial markets. When prices fall sharply, people look around and see everyone else selling. News headlines scream catastrophe. Social media fills up with people declaring the end of crypto. And the brain, wired for social survival, interprets that consensus as information. If everyone is running, maybe there really is a lion. Maybe I should run too.
But here's what the herd almost never sees. Markets don't move in straight lines, and the moments of maximum fear are often, not always, but often, the moments that offer the most significant opportunities for disciplined, patient, long-term investors. The people who built real wealth in Bitcoin didn't do it by timing the market perfectly. They did it by staying in the market when staying in was psychologically excruciating. Now let's talk about the other side of the emotional coin, because greed is just as dangerous as fear, and it's a lot more fun, which makes it even more treacherous. When Bitcoin is rising fast, when your portfolio is doubling and tripling, when everyone in your circle is talking about their gains, something shifts in the brain. Dopamine floods the system. Confidence inflates. Risk feels invisible. This is the psychological state that causes people to go all in near market peaks, to borrow money to buy more, to dismiss the idea that anything could ever go wrong. This pattern has a name in behavioral finance. It's called recency bias. The human brain is extraordinarily bad at distinguishing between "this has been happening recently" and "this will continue to happen forever." When prices rise for months, the brain starts to encode rising prices as the natural state of things. When they eventually correct, as they always have, those same investors feel blindsided, betrayed, even victimized. But the market didn't change. Their perception of risk had simply been distorted by a prolonged period of good news. And this is where we need to talk about FOMO, the fear of missing out. Because in the world of crypto investing, FOMO might be the single most expensive psychological condition a person can develop. FOMO is what drives investors to buy assets after they've already risen dramatically, not because of analysis or conviction, but because of the unbearable feeling that everyone else is getting rich and you're being left behind. It feels urgent, it feels rational, it feels like an obvious opportunity, and it is almost always a sign that the rational part of your brain has been temporarily hijacked by your emotional brain. The investors who consistently make costly mistakes in Bitcoin markets are not unintelligent people. They're not uninformed people. Most of them are smart, motivated, financially literate individuals who simply haven't learned to recognize when their emotions have taken the steering wheel. They buy because everyone's buying. They sell because everyone's selling. They check their portfolio dozens of times a day, each price movement triggering a fresh emotional response. They confuse activity with progress, and they confuse discomfort with danger. Now, let's look at the psychology on the other side. What does the disciplined, long-term oriented investor actually do differently, not just in action, but in how they think? The first and perhaps most important difference is that successful long-term investors in volatile assets develop what psychologists call a high tolerance for ambiguity. They've made peace with the fact that they cannot know what will happen next week, next month, or next year. Instead of chasing certainty, which markets will never provide, they focus on the variables they can actually control: how much they invest, how they respond to volatility, and whether their decisions are driven by a long-term thesis or by short-term emotion.
The second difference is in how they relate to market crashes. For the psychologically unprepared investor, a crash is a catastrophe. For the disciplined long-term investor, a crash is data. Uncomfortable data, emotionally demanding data, but data nonetheless. They've studied enough financial history to know that every significant asset class has experienced dramatic drawdowns and eventual recoveries. That knowledge doesn't make volatility painless, but it does make it interpretable. And that's everything. There's also a crucial mindset distinction between speculation and investing, and it's one that most people in the crypto space never make explicitly. Speculators enter a market asking, "How do I profit from the next move?" Investors enter a market asking, "Do I believe in the long-term value of what I'm buying, and can I hold it through the inevitable turbulence that comes with any high-growth, high-risk asset?" Those are fundamentally different questions, and they lead to fundamentally different behaviors when markets become volatile. Speculators tend to be perpetually reactive. They're always looking for signals, always adjusting, always trying to optimize for the next 30 days. And the research on active trading in volatile markets is sobering. It consistently shows that the more frequently individual investors trade, the worse their long-term returns tend to be. Not because trading itself is inherently wrong, but because most people trade in response to emotion, and emotion is a notoriously unreliable guide to financial decisions. This brings us to one of the most counterintuitive insights in all of behavioral finance. Sometimes, the most productive thing an investor can do is nothing. Not because passive is always better than active, but because in moments of market panic or market euphoria, the default human instinct is almost always wrong. The urge to act, to do something, To fix the problem or chase the opportunity is exactly what leads to buying high and selling low, the most reliable path to underperformance. Successful long-term investors develop what you might call a practiced inertia. They've thought carefully about their investment thesis in advance, during calm, rational moments. They've decided how much volatility they can genuinely tolerate, not how much they think they can tolerate when markets are stable, but how much they can actually live with when their portfolio is dropping and the headlines are screaming. And then, when the storm arrives, they return to that pre-committed decision rather than improvising under emotional duress. There's a concept in psychology called the planning fallacy, our tendency to imagine the future under idealized conditions rather than realistic ones. Most people think about investing during calm markets and assume they'll stay calm when volatility arrives. Almost no one does. The question isn't whether you'll feel fear during a market crash. You will. The question is whether you've built enough understanding and conviction about your long-term thesis that you can act according to your plan rather than your panic.
And here's something worth sitting with. The investors who've experienced the most painful losses in Bitcoin aren't the ones who bought and held through multiple market cycles. They're almost always the ones who bought during moments of peak excitement, watched prices fall, held longer than they planned because selling felt like admitting defeat, and then finally sold at the lowest point of their emotional exhaustion. That sequence, buy high, hold in denial, sell in despair, is one of the most common patterns in all of investment psychology, and it plays out in every asset class, not just crypto. So what are the practical lessons here? What can you actually take from this and apply to the way you think about money and investing? Start by getting honest about your real risk tolerance, not the theoretical version, but the version that exists at 2 in the morning when your investment has dropped 40% and you can't sleep. If that scenario would cause you to make impulsive decisions, then either your position size is too large or your conviction in your thesis isn't strong enough. Both of those are solvable problems, but only if you identify them before the volatility arrives. Separate your investment decisions from your emotional states. One practical way to do this is to write down your investment thesis when you're calm, why you're investing, what time frame you're thinking about, what level of loss you're prepared to accept, and what specific circumstances would genuinely change your thesis rather than just make you uncomfortable. Then, when markets move dramatically, you have a document to return to instead of just your feelings in the moment. Understand that financial literacy isn't just about knowing how markets work, it's about knowing how you work inside those markets. The most financially dangerous person in any room isn't the one who knows the least about investing. It's the one who knows just enough to be confident, but hasn't yet developed the self-awareness to recognize when their emotions are driving the vehicle. And finally, and this might be the most important thing in this entire video, recognize that patience is not a passive quality. In volatile markets, patience is an active, disciplined, daily choice. Every time the market moves dramatically and you choose to revisit your thesis rather than react to your emotions, you are exercising a skill. Every time you resist the pull of FOMO or the push of panic, you are building something, not just a financial position, but a relationship with uncertainty. And the ability to sit with uncertainty without being destroyed by it is one of the rarest and most valuable capabilities a person can develop in investing and in life. The people who've built real wealth through Bitcoin, through any long-term investment in a volatile, high-growth asset, share one thing more than any other. It isn't intelligence. It isn't insider knowledge. It isn't perfect timing. It's the ability to remain psychologically coherent when everything around them is encouraging them to fall apart. That quality can be cultivated, it can be learned, and it begins the moment you decide to understand your own mind as clearly as you try to understand the market. Markets will always be unpredictable. Human nature doesn't have to be.
Hit that like button if this message resonates with you. Share it with someone who needs to hear this. This channel is still growing, and we're truly appealing to you to support us by subscribing to the channel for full, powerful finance and wealth-building videos. Turn on the notification bell so you don't miss our future content. Drop your comments and questions below. We'd really love to hear from you.
Thank you so much for watching and supporting this channel.